Have you ever tried sifting through a corporate earnings call? It often feels less like a straightforward financial report and more like a carefully choreographed performance, right? Where optimism just reigns supreme, almost regardless of what the numbers are actually doing. Cutting through that spin to find what's really going on. That's the challenge. Well, today we're tackling exactly that. We're going on a deep dive into Commercial Metals Company, or CMC, a major player in the steel and metals industry. We're going to pull back the curtain a bit on how they communicate their performance and, maybe more importantly, what it truly means for their business and, their strategic direction.
Yeah, and for this deep dive, we've got a pretty fascinating blend of sources. We've actually looked at a satirical take on one of CMC's past earnings calls, specifically their Q3 2024 call, and we're contrasting that with the actual, the unedited transcript from their most recent Q3 2025 earnings call. What's really powerful about this combination, I think, is it lets us see both the story CMC wants to tell and what the hard numbers can actually reveal. It's kind of an unparalleled lens into corporate communication.
Okay, let's unpack this then. Our mission today is basically to cut through all that corporate jargon, identify the truly important nuggets of information, and help you understand what's really happening with CMC, its markets, and its strategic direction, all without feeling, overwhelmed. Think of it like observing a fascinating corporate ritual and then decoding its true significance if these calls are a performance. Well, today we're sitting front row for CMC's latest act. So let's begin by looking back a bit at how companies sometimes frame their results. Our first source gives us that satirical, yet frankly incredibly insightful look at CMC's Q3 2024 earnings call. It really highlights how the message can sometimes diverge from the raw numbers.
Well, absolutely. And what's fascinating here is how this satire just perfectly captured the archetypes you often hear on these calls,
Yeah.
right? You had Peter Matt, the CEO, portrayed as the visionary leader, just brimming with relentless optimism. He used these grand terms like long-term structural trends, reshoring, energy security, and he famously introduced the TAG program, Transform, Advance, and Grow, almost like it was this magic cure-all for any issues they might have. Then there was Paul Lawrence, the CFO, the financial gymnast, a master of jargon, making kind of underwhelming numbers sound acceptable by emphasizing strong liquidity and sequential improvements, while neatly glossing over those year-over-year declines.
Yeah.
And finally, Satish Kasinathan, the analyst, the voice of reality, polite but pointed, armed with the company data, asking the tough questions.
That's the core tension right there, isn't it? Because while the company called those Q3 2024 results historically strong, they were in fact significantly lower than the previous year. We're talking net earnings of around, $119 million, which was down from approximately $234 million in Q3 2023.
A very big drop.
And a core EBITDA, that's their earnings before interest, taxes, depreciation, and amortization, a key measure of operational profitability. That declined from about $385 million in Q3 2023 to around $256 million in Q3 2024. That's a pretty stark difference. So, yeah, the satire hit the nail on the head. Optimism reigns supreme.
But seeing these numbers year over year, what's the single biggest truth about CMC that this two-year comparison reveals? Is it just corporate spin or maybe something more fundamental about their market position?
Well, I think the core insight here is that even with ambitious long-term plans like TAG, a foundational industry like steel, it can't easily outrun persistent macroeconomic shifts. The numbers show a clear decline, indicating that while strategy is absolutely key, market forces often have the final say, certainly in the near term. And this raises that important question. How were concepts like strong liquidity and share repurchases used in that context? They were presented in a way that you could argue served as potential distractions from those declining profitability figures. It's about shifting the focus, right? Reminding investors about financial stability even when earnings are soft.
And the skeptical analyst in that satirical take had the perfect question, didn't he? How do you reconcile your optimism with the fact that the company is substantially less profitable than it was a year ago? Gets right to the heart of it.
Absolutely. And the satire depicted the CEO and CFO kind of teaming up to, evade that question, pivoting skillfully back to the long-term vision, the promise of the TAG program, and the ever-present macroeconomic uncertainty. This really sets the stage for how these narratives, this kind of strategic communication, continues in the most recent earnings call.
Right. So having seen let's call it the highlight reel of last year's carefully framed results, let's now fast forward to the very latest performance, their Q3 2025 earnings. Did the visionary leader manage to conjure new numbers, or did reality continue its persistent march?
Well, let's look at the core Q3 2025 financial results. CMC reported net earnings of $83.1 million, or 0.73 cents per diluted share. That's their earnings per share, considering all the shares that could potentially be outstanding. Adjusted earnings came in slightly higher at $84.4 million, or 0.74 mulun per diluted share. Now, it's important to note these results actually missed analyst expectations, which were around 8.2251 TERS per share.
Okay, so miss there.
A miss, yeah. And critically, if we compare these to the prior year, that Q3 2024, adjusted earnings then were $119.6 million, or 1.02 cents per diluted share. So that demonstrates a continued year-over-year decline in earnings. It's not reversing yet.
Still heading down.
Still heading down. Consolidated core EBITDA was $204.1 million, which is a further decline from $256.1 million in Q3 2024. And the core EBITDA margin was 10.1%, down from 12.3% in Q3 2024. So yeah, if we strip away all the adjustments, CMC's core earnings are down significantly year over year. That's really the headline. And their operational profitability measured by EBITDA is also continuing to slide. It's a clear trend.
So despite those numbers, the CEO describes CMC's ongoing strategy as game-changing. The Transform, Advance, and Grow TAG program is still front and center, isn't it? Expected to yield approximately $50 million of EBITDA benefit this fiscal year, 2025. With an anticipated annual run rate benefit of over $100 million when it's fully realized. The CEO called their strategy game-changing, yet the numbers aren't quite reflecting that yet. Is this common for such large initiatives, or does it signal maybe a potential disconnect between aspiration and reality?
It's not uncommon, no. Strategic initiatives definitely take time to impact the bottom line, especially in a capital-intensive industry like steel. It's a big ship to turn.
Yeah.
What's fascinating here, though, is the continued emphasis on these powerful long-term secular trends and powerful tailwinds that management believes will drive demand. They cited investment in national infrastructure, reshoring industrial capacity, growth in energy generation and transmission, and even the build-out of AI infrastructure. That's a big one these days.
Everyone's talking AI infrastructure.
Exactly. They also mentioned addressing the U.S. housing shortage, estimated at 2 to 4 million units. And to put this in perspective, they referenced a staggering $1.6 trillion of corporate investments announced just in calendar 2025 across AI, manufacturing, shipping, and energy, suggesting these could provide significant catalysts down the road. And what's fascinating is these aren't just internal buzzwords. We even found an investment piece circulating that screams these very same trends, almost like CMC is writing a pre-existing wave of market narrative.
Oh, that's interesting. You mean a completely separate piece, not from CMC, but highlighting these exact trends? Because, yeah, as we dug through your materials, we found another intriguing piece, this compelling investment thesis being presented to investors.
Exactly that. This separate narrative, framed as an advertisement, actually claims there's one undervalued stock connects all the dots before it explodes. Strong headline.
Very strong.
It directly links the AI infrastructure supercycle, noting AI needs energy, and data centers consume as much as a small city. It also ties into the onshoring boom driven by tariffs, a surge in U.S. LNG exports, and a unique footprint in nuclear energy, calling it the future of clean, reliable power. The piece claims this unnamed company, presumably the one they're promoting, is completely debt-free and sitting on a war chest of cash, equal to nearly 1/3 of its entire market cap. It also asserts ownership of a huge equity stake in another red-hot AI play, offering sort of indirect exposure. And the claim is that it's trading at less than 7 times earnings, excluding cash and investments, and that secretive hedge fund managers are pitching it.
Wow, that's a powerful narrative, even if it is an advertisement. This piece highlights these huge macro trends that overlap with some of CMC's own strategic pillars, right? Like AI infrastructure, tariffs, energy. It offers a fascinating, albeit maybe aspirational, parallel view of how different companies are positioning themselves for these large-scale shifts. It really shows how the market narrative around certain trends can be incredibly strong, influencing how companies frame their own stories. But what's the ultimate nugget of knowledge for our listener here? How does a company like CMC, entrenched in a traditional industry like steel, truly connect the dots between rebar and the AI supercycle?
Well, for a company like CMC, connecting those dots means recognizing that the physical infrastructure needed to support these big trends, the data centers, the new factories, the power plants, the transmission lines, all require massive amounts of steel. It's about being the foundational supplier for the picks and shovels of this new economy, if you like.
Okay, picks and shovels, I like that. But beyond the raw numbers and the big picture, the devil is always in the operational details, isn't it? So let's pull back the curtain a bit more on how CMC's different segments actually performed under these conditions.
Right. So in the North America Steel Group, adjusted EBITDA decreased 24% year over year. That's mainly due to lower margins over scrap metal. However, there was a sequential improvement from the previous quarter, with Q2 2025 described as a trough, or the low point. Looking at volumes, average daily shipments of finished steel actually increased 3.2% year-over-year in Q3 2025, and combined daily rebar shipments grew 1.3%.
Okay, volume's up slightly.
Slightly. But an analyst actually highlighted that this was below the typical seasonal pickup you'd expect, maybe 10–15%.
Mm.
The CEO attributed this to some outages late in the quarter and production challenges, expecting volumes to be flattish to slightly up in Q4. On pricing, the CEO reiterated a focus on commercial excellence and value over volume, emphasizing a balance between what's right for CMC, the customer, and incentivizing Buy America.
Mm.
Even in their fabrication business, which had a competitive Q3 with booking prices sliding, the team is focused on operational excellence, walking away from unprofitable jobs. And they're addressing duration risk. That's a key term. They're insisting on proper escalators in contracts, aiming to make it a more profitable business even in a market trough.
Explain that duration risk a bit more. Escalators.
Sure, duration risk basically means getting locked into long-term contracts at fixed prices, only to see your own costs, like materials or labor, surge later on, squeezing your profit. So by adding escalators, they're building in clauses that allow their prices to adjust if their key costs go up significantly. It protects their margins over the life of the contract.
Got it. Protects the downside. That makes sense. It paints a picture of a company really working to optimize its operations amidst these challenging market conditions. It sounds like CMC is trying to turn a supertanker in choppy waters, a massive undertaking that just takes time and precision. And speaking of optimization and long-term plans, let's talk about the progress on CMC's major organic growth projects. The micro mills, how are those coming along?
Okay, so for Arizona 2, the CEO reported very good progress, exiting the quarter at around 70–75% utilization. That's pretty good ramp-up speed. He expects the facility to actually generate a profit in Q4, which would be a nice milestone. And the mill has already achieved production of 75% of SKUs by volume for merchant bar quality MBQ products.
What does that mean exactly, 75% of SKUs?
It means they've successfully launched production for 3/4 of the different types of merchant bar products they plan to make there. It shows the mill is becoming versatile, not just making one thing. It's a big step for a new mill. Now, Steel West Virginia, that saw its melt shop production delayed, pushed back to spring of calendar 2026.
Ah, a delay. Why?
Well, a primary reason given was the pursuit and attainment of Inflation Reduction Act tax credits. These are expected to yield a net benefit of approximately $80 million. Big number.
$80 million.
Yeah. So it's essentially these substantial tax credits came with specific strings attached compliance requirements. To qualify and maximize that benefit, they had to slow down construction and modify their plans a bit. So a strategic pause, if you will, to ensure they met all the criteria. The second factor mentioned was weather delays, resulting in approximately 70 days of lost construction time. That happens. But crucially, the CEO explicitly stated the delay was not driven by a less robust near-term market outlook. Management remains optimistic about future demand. When fully operational, these two projects together are expected to contribute over $150 million in incremental EBITDA and improve return on invested capital, or ROIC, by about 150 basis points. That's improving their ROIC by 1.5 percentage points.
This micromills delay, pushing West Virginia to 2026, that's a significant shift. And the reason given tax credits is fascinating. Is this a shrewd financial move, or does it maybe betray a hidden caution about the immediate market, despite what they say?
It definitely looks like a shrewd move on paper. Sacrificing a few months of production for an $80 million tax credit makes financial sense, especially if their long-term demand outlook remains strong, as they claim. And regarding the updated capital spending outlook, the FY 2025 guidance was actually reduced to $475 million. That's down from $600 million previously. Largely due, it seems, to the timing shifts for the West Virginia project, pushing costs out. For FY 2026, CapEx, that's capital expenditures, money spent on assets, is expected to be around $550 million gross, or roughly $450 million net after those tax credits and other incentives kick in.
Okay, so shifting gears slightly to the Emerging Businesses Group, the EBG. That saw net sales up 4.7% and adjusted EBITDA up 7% year-over-year. Beyond the core steel, CMC's EBG seems to be their high-margin growth engine. What specifically makes these proprietary products so valuable compared to their traditional offerings?
Right. This group's performance was really driven by demand for their proprietary products, things like Interix Geogrid, Galvabar, Chromax, CryoSteel, and various anchoring systems. These aren't just commodity products like basic rebar, they're engineered solutions. They solve specific, often high-value problems for customers. And that allows CMC to capture higher margins and be less exposed to the cyclical swings in basic steel prices. The geogrid solution, for example, they highlighted benefits like reducing construction costs, project duration, labor needs, and even CO2 emissions while extending the asset's life. Real value add. The EBG targets mid-single-digit organic growth and high teens EBITDA margins. So it showcases a more specialized, higher margin growth vector for the company. We also saw improving conditions in the Europe Steel Group that actually swung from a $4.2 million loss in Q3 2024 to a $3.6 million profit in Q3 2025.
A nice turnaround there.
Yeah, a positive swing. These improvements were attributed to reduced import flows into Europe and growing construction demand, so a better environment there. They mentioned new Polish infrastructure spending programs and the prospect of Poland's first nuclear power plant, with construction starting around 2027 as future demand drivers. There's also potential for increased demand in Germany from a huge 500 billion euro infrastructure bill and increased defense spending, possibly kicking in as early as Q4 2025 or early 2026. And another significant point for Europe, an approximately $28 million CO2 credit is expected in Q4 2025 due to Polish legislation. That'll clearly benefit their bottom line in the near term.
Okay, quite a bit happening across the different segments. So how is CMC managing its capital amidst all these initiatives, the micro mills build out, the EBG growth, and where are they looking for new opportunities for future growth?
Yeah.
Acquisitions, maybe?
Yeah, on the capital front, the company boasts strong liquidity. They have over $1.7 billion available. That's made up of $893 million in cash and $834 million in credit availability. So plenty of firepower.
Heavy balance sheet? Seems so. On the share repurchases front, CMC returned approximately $71 million to shareholders in Q3 2025, repurchasing 1.1 million shares at an average price of $45.30 per share. About $254.9 million remains under the current buyback authorization, and the company emphasizes a balanced approach to capital allocation, returning cash, but also investing. And you mentioned acquisitions. That's where their focus on inorganic growth comes in. They're actively looking to enter what they call attractive adjacencies within the broader $150 billion early-stage construction market. Their criteria for targets, well, they don't want to stress the balance sheet, so they're aiming for a net debt to EBITDA ratio below 2x after a deal. The ideal valuation range they mentioned is $500 million to $750 million for a target company. And financially, they're seeking businesses with EBITDA margins above 20%, much higher than their core steel business, and free cash flow conversion above current CMC levels. The CEO acknowledged that these types of businesses often trade at higher multiples than CMC itself.
Right, better businesses, higher price. Exactly. But he stated a discipline to bring the effective multiple down to CMC's level over 3-4 years through synergies and growth from the acquired company. The inorganic pipeline, they described it as good, with some processes quite mature, although general market uncertainty is apparently slowing down deal flow across the board right now.
Okay. We've certainly covered a lot of ground. We've navigated the structured optimism of the earnings call, explored CMC's ambitious strategic plans for growth and efficiency with TAG and the micro mills, all while keeping a close eye on the core financial realities, those declining year-over-year numbers.
Yeah, we've seen how a company like CMC is trying to balance these current market challenges, lower margins, softer volumes in some areas, with these long-term game-changing visions, leveraging macro trends like infrastructure, reshoring, and even, booming demand from AI, despite those ongoing year-over-year profit declines. It's a balancing act.
So for you, the listener, the takeaway seems clear. Understanding corporate communications means looking beyond the buzzwords, right? Getting to the underlying numbers and strategic moves, but also recognizing the broader market narratives at play, even when those narratives come from, advertisements hyping up similar trends. For you, tracking industrial trends, these numbers, these strategies, they're more than just figures. They tell a story about market demand, operational efficiency, and maybe future direction.
So what does this all really mean for you?
And here's where it gets really interesting, I think.
Considering CMC's ongoing year-over-year profit declines, starkly juxtaposed against its confident game-changing strategy, the TAG program, the micro mills, and you layer on the broader market's enthusiastic pursuit of AI and energy-related investments. What does it truly take for a company in a foundational industry like steel to actually transform, advance, and grow its bottom line in a meaningful way in today's environment? That's the billion-dollar question, isn't it?